All right, let's jump right in. We're looking at a pretty detailed U.S. market analysis that came out on Monday, March 9th, 2026. We're going to break down the day's pretty wild market action, get into the geopolitics behind it, and see what the big Wall Street firms were thinking.
Okay, before we get into the thick of it, we have to cover the important notice. Now, this document is purely for informational purposes. It is not investment advice. As you know, investing carries significant risk. We'll hit the full professional disclosure again at the very end, but it's just super important to remember that this is simply an explainer of the original source material.
So, here's the game plan for today. First up, we'll get a big picture overview of that crazy market reversal. Then, we'll dig into the geopolitics and the messaging that was driving the whole thing. After that, we're looking at Goldman Sachs' assessment on oil supply, JP Morgan's more bearish take, the technicals, the charts and key levels, and we'll wrap it all up with a strategy summary. Sound good? Let's do it.
All right, first up, the broad market overview. And really, there's no other way to put it. This was a violent V-shaped reversal that happened on March 9th.
The day's action was a total tale of two cities. It kicked off with this massive, accelerated sell-off, mostly because of some escalations in the Middle East over the weekend. The S&P 500 just gapped down right at the open, falling below that key 6,700 level. And when that happened, bam, it triggered a huge wave of systematic selling. And you know what that is, right? It's basically the algorithms, the automated trading programs just kicking in and selling because the price hit their preset trigger. But then, everything changed. And I mean dramatically.
So, what flipped the switch? Well, it was really two things. First, right in the middle of the session, the G7 put out a statement hinting they might release oil from their strategic reserves. That kind of calmed everyone's fears about supply. Then, get this, in the last 40 minutes of trading, some supportive comments came out of the White House, and that sparked a massive short-covering rally. You know how that works. All the traders who were betting the market would go down suddenly had to rush to buy back shares to cover their positions, and that just shot prices even higher.
And here you can see just how powerful that reversal was. By the close, the Nasdaq was up 1.32%, the S&P 500 up 0.83%. The Russell 2000 finished up a full percent. Even WTI crude, after a total roller coaster of a day, ended up 4.72% in after-hours trading. And if you look at the sectors, 9 out of the 11 ETFs finished in the green. Only energy and financials were down. I mean, just a truly wild turnaround.
Okay, so that leads us right into our second section. Geopolitics and expectation management. This is where we get into the White House's communication strategy, which the original analysis calls strategic ambiguity.
So what on earth is strategic ambiguity? Well, the analysis breaks it down like this. It's a communication strategy where you're constantly, dynamically adjusting your objectives. The whole point is to create what they call a volatility tax on anyone trying to speculate, especially in the oil markets. It's basically designed to keep speculators totally off balance and constantly guessing.
And this is where it gets really interesting. Look at how the messaging evolved. During the trading day, the talk was pretty optimistic, right? Like a resolution was expected in maybe 4 to 5 weeks. But then, after the market closed, the tone shifted. Suddenly it's not going to end this week, but it will end soon. You can see these little adjustments all over the place, from military objectives to the talk about regime change. It just created this fog of uncertainty.
And the analysis makes a pretty interesting comparison here. It says, and I'm quoting, "This guess what we mean style of expectation management essentially borrows from the Federal Reserve's communication playbook." And here's the bottom line. It worked. It completely disrupted those one-way bullish bets on oil, where everyone just piles in thinking prices can only go up. And it really hammered the momentum traders who were just chasing the rally.
All right, so we've talked about the messaging and the psychology. Now let's get into the hard physical reality. Section 3 is all about the oil supply and demand fundamentals, and we're looking at this through Goldman Sachs' eyes and their assessment of the upside risk.
So, while all that messaging stuff can move markets in the short term, Goldman's point is that the physical supply is what really matters in the end. And the numbers here are, they're pretty stark. You've got throughput in the Strait of Hormuz down by 90%. 90. The efforts to reroute oil through pipelines, they're only at 25% of their goal. And the big shipping companies, they're just sitting on the sidelines because they can't get war risk insurance. So Goldman's warning is pretty direct. If oil stays over $100 for 1 to 3 months, you're going to see serious demand destruction. High prices will just force everyone to cut back.
I mean, let's just pause on this number, 18 million. That 90% drop in the Strait of Hormuz, that translates to taking 18 billion barrels of oil per day off the global market.
Just think about that. That is a huge chunk of the world's entire supply, and that's a massive physical problem that you just can't fix with a press conference.
Okay, so you've got this major tug of war, right? Between the political messaging on one side and the physical supply reality on the other. So how are the big banks playing this? Well, that takes us to Section 4, where we look at JP Morgan's tactical bearish view. It gives us a great look into how these big institutions are trying to control their risk.
JP Morgan's call was to get tactically bearish. They put out a target saying the S&P 500 could drop to 6270. But, and this is a big but, they made it very clear this was a tactical call. It was all about the immediate geopolitical risk, not some fundamental change in their long-term outlook for the economy. And they even put a number on the economic damage. If oil holds above $100, they're expecting a 60 basis point hit to Q1 GDP growth.
All right, let's switch gears and look at the charts. Section 5 is all about the technicals. We're going to dive into the day's price action and specifically keep an eye on that selling pressure from the CTAs, the commodity trading advisors.
The whole trading day was really just a battle over a few critical price levels. So at the open, the S&P broke below that 6,700 level, which was a big trigger for the CTAs. But then the buyers, the bulls, drew a line in the sand at 6,600. The source actually calls this the life or death line, and that's because it's right around the 200-day moving average, which is a massive long-term trend indicator for so many people. Holding that line was psychologically huge. If it had broken, the next stop was likely all the way down at 6,140.
So what about all that automatic selling from the big systems? Well, based on one strategist's model, the analysis suggests that about half, 50% of the potential CTA selling has already happened. Now that's kind of a double-edged sword. It means there's firepower to buy back in if the market bounces, but it also means there's another 50% of selling just waiting in the wings, ready to go if we break below that critical 6,600 level.
But even with all that crazy volatility, the way the daily charts actually closed is really important. If you look at the candlestick patterns for the major indexes, they all formed what looks like a clear stabilization pattern. You know the ones I mean, they had that long wick at the bottom. That tells you that even though sellers pushed prices way down during the day, buyers came roaring back and pushed them right back up by the end. So what's the takeaway? We're seeing the first technical hints that a bottom might be forming.
Okay, so this all leads to the big finish, our strategy summary and action guide. How do we make sense of all this and put it together?
The analysis really boils it down to two main possibilities. On the bull side, if the Strait of Hormuz reopens before April and oil gets back under $80, then the S&P 500 could smash through 6980 and maybe even hit new highs. But the bear case, if the geopolitical situation gets worse and we lose that key 6,600 support level, then you could see a very fast slide down to 6,140.
So what does the playbook look like according to this analysis? Number 1, focus on capital preservation. This is not the time for high-frequency trading when headlines are flying around. Number 2, watch the physical commodity flows like a hawk, especially any news at all about the Strait of Hormuz. And number 3, be disciplined with your risk control. That means using hard stop losses, particularly around that all-important 200-day moving average.
So when you put it all together, what's the real takeaway here? Well, it's this. Yeah, we've seen some really promising signs that the market is trying to carve out a bottom, but the risk is absolutely not gone. Not by a long shot. The biggest wild card is still the geopolitical situation. And until that de-escalates in a real, meaningful way, the name of the game is staying vigilant and staying flexible.
And we'll close out with the official risk disclosure one more time. Remember, this document is for informational purposes only. It is not financial advice. Any and all investment decisions are made at the reader's own risk.